Hello team, welcome back to a new educational video. This one is about trading time zones, what most traders ignore. Because they look for entries, indicators and setups. But they ignore one of the most important part of trading, timing. Because a perfect setup at the wrong time is often a bad trade. The market does not move the same all day. Liquidity changes, volume changes, and behavior changes. And if you don't understand when money enters the market, you are trading blind. So in this video, we'll break down what are the main sessions, where liquidity builds, how New York behaves differently, and what are the most important times of the day. Because trading is not just about where price is, it's also about when price moves. So let's get into it. Sessions are about liquidity, not time clocks. London Open, New York Open, or Asia Open. But sessions are not really about the time on the clock. They are about liquidity entering the market. That's the real reason they matter. When a major session opens, institutions become active. Volume increases, volatility expands, and liquidity gets targeted. That's when the market starts moving with intention. Why this matters? It matters because a setup during dead hours has low volume, weak follow-through, and fake breakouts. The same setup during active session hours has stronger momentum, better entries, and cleaner moves. Same chart, different timing, different result. So don't just ask where price is, also ask what time is it. There are three major sessions: Asia, London, and New York. Each one has different behavior, different liquidity, and different opportunities. Asia session has usually slower movement, tighter ranges, and more often than not, consolidation. On London session, volume starts building. It's usually when expansion begins, liquidity gets swept, and major direction often forms. But on New York session, things get interesting. Because New York often does one of the two things: continuation, it continues what London started, or reversal, it completely reverses it. And understanding which one is happening is a huge edge. For example, we have here a New York continuation. We have London Open, it holds the structure, and then price starts to print higher lows. From here, momentum is strong. When New York opens on this candle here, it just continues higher. Volume supports the move, structure is clean, and no major reactions appear. Now let's see a reversal example. And we have this one here. On London Open, price aggressively pushes up. It reaches major liquidity or resistance and becomes overextended. Then New York opens, takes the liquidity above London high, pushes a bit higher, and then reverses the entire move. Why this happens? In this scenario, London creates the liquidity grab, and New York delivers the real intention. A lot of times, London pushes aggressively into highs. Breakout traders enter late, stops from short sellers get triggered, and liquidity gets taken. But that move was never meant to continue. It was meant to create liquidity for larger players to enter the opposite side. So when New York opens and real volume comes in, price reverses sharply. And this is how we have our next rule. Don't assume New York Open will follow London. Watch if it confirms or rejects it. The most important session is the overlap between London and New York, and that happens between 1 to 5 UTC time. This is the highest liquidity and highest volatility period, because now Europe is fully trading, US is opening and active, and institutions and large players on both sides are involved. During the overlap, we have the highest liquidity. More buyers and sellers are in the market. And this means smoother execution, less random movement, and stronger reactions at key levels. So we have strong momentum. When price breaks structure here, it often has real follow-through, not weak fake breakouts. We also have best larger players' participation, because this is the time window when they are most active. We see cleaner breakouts. A breakout during overlap is much stronger than the same breakout during dead hours, because volume supports the move. Without volume, breakouts fail. With volume, they expand. And we also see stronger reversals. If price reaches major liquidity during the overlap, reversals can be sharp and fast, because now enough volume exists to reprice the market. So if you only trade one window, make it the London and New York overlap. Sessions matter more in futures than in crypto, because futures are heavily driven by institutional market hours. Crypto trades 24/7, so session boundaries are softer. Some of the most important times are the 9:30 a.m. New York open time. I like to call this one the cash open. This is where serious volatility begins, massive liquidity, major traps, and major breakouts. Before this time window, pre-market movement builds. Traders position early. Liquidity forms around the highs and lows, and many traders try to predict direction. Then, when the open hits, the market often does something completely different. And that often means that previous highs and lows get swept, breakout traders get trapped, and fake moves happen fast. At New York Open, you'll often see strong impulse candles, sharp reversals, aggressive stop hands, fake breakouts, and fast continuation moves. Sometimes price first moves one way, just to reverse hard the other way. This is why so many traders get trapped here, because they enter too early, chase the first candles, and assume the first move is the real move. Instead of reacting to the first candle, it's better to wait for the open to settle. Let liquidity get swept, structure form, and confirmation appear. Then trade the real move, not the opening chaos. The next important hour is 8:30 New York time, because this is the economic news release zone. Think about CPI, NFP, PPI, unemployment, all the important news. It is a very dangerous zone if unmanaged because price can move aggressively in seconds. At this hour, you'll often see huge candles, instant stop hands, spread widening, slippage, fake breakouts, and sharp reversals. Why you lose here? Because sometimes price moves both directions first. It sweeps highs, then lows, before showing the real direction. This traps a lot of traders. So you enter late, your spread gets worse, stop losses get hit instantly, and volatility kills the setup. Even if the idea was correct, execution becomes dangerous. The next one is 10 a.m. New York time. This is also called secondary expansion. Often real move starts here, because by this time, the news volatility has settled. The cash open injection is done, and early liquidity sweeps have already happened. Now the market starts showing its true direction. The next one is 2 p.m. New York time. This is the Fed zone, and is one of the most explosive times in the market, because around 2 p.m. New York time, major Federal Reserve events often happen. Things like FOMC rate decisions, Fed statements, Powell speeches, interest rate guidance, monetary policy updates. And when this hits, the market can move violently in seconds. You'll often see huge candles in seconds, instant reversals, fake breakouts, spread widening, slippage, and stop hands in both directions. Sometimes price will explode up first, then completely reverses down. Or the opposite, this creates chaos. Most traders lose here because they try to predict the announcement. But even if the direction is correct, execution becomes dangerous. Because entries get slipped, stop losses get skipped, spreads become huge, and volatility ignores normal structure. You can be right and still lose. So, while trading, keep in mind these hours. If you are not an experienced trader, maybe it's best to just watch the price action and learn. So, to sum it up, futures typical behavior is on mornings is fast and violent, midday it's slow and choppy, and on the last hour of the trading session, strong moves happen again. Crypto sessions are a little different. Sessions still matter, but differently, because crypto never closes. There's no true market open. Instead, we watch when big players wake up, especially the US traders. And on crypto, we also have weekend behavior. Because it's a 24/7 market, you can trade on weekends. But weekends often have low liquidity, fake moves, and stop hands. This is classic crypto behavior. So why not better enjoy some time off the charts or learn something new? I've mentioned a few times during this video the idea of liquidity hunt. Let's talk a little about it. Liquidity is where traders place orders, and the market moves toward liquidity, especially during major sessions. You'll often find liquidity around previous day high and low, equal highs or lows, session high and low, and range highs, range lows. These become magnets for price because stops are sitting there. When a major session opens, especially in New York, one of the first liquidity targets often becomes the previous session's high or low. For example, London session creates a high and a low. New York opens, price often attacks one of those levels first. Why? Because that's where liquidity is sitting. Stops build above highs and below lows. And when fresh volume enters during New York open, price often moves there first. Then usually one of the two things happen, as we discussed earlier. We either see a rejection or a strong hold and a continuation. Same on the downside with the previous session low. This is why session highs and lows are important. They become magnets for price. Liquidity is often the destination before the real move begins. Now, let's talk about the mindset. Good traders don't just ask, is this a good setup? They also ask, is this the right time for this setup? Because timing improves everything. Entries, confirmations, risk management, and consistency. Let's say you see price at support with VWAP confluence, looks like a great long, but then you ask, what time is it? If it's in the middle of London session with low volume and no session liquidity yet, maybe the trade is too early. Now compare that to New York Open. Previous London low gets swept and strong reaction candle appears. Now the setup has timing, now it has context. The best traders are not just patient with price, they are patient with time. When you trade at the right time, entries improve because price reacts with more intention. Confirmation improve because volume and momentum become clear. Also, risk management improves because cleaner moves mean tighter invalidation, better stop-loss placement, and stronger risk-reward opportunities. And finally, consistency improves because you stop forcing trades in dead hours, and fewer bad trades means better long-term performance. Most traders spend years trying to improve entries while completely ignoring timing. But the truth is, when you trade matters just as much as what and how you trade. Because liquidity creates opportunity, and if you understand where and when the liquidity enters, you stop chasing the market and start trading with it. In the next video, we'll be talking about the profit-taking guide every trader needs, because a good trade with a bad exit can still become a bad result. We'll include where to take profits, partials versus full take profits, why most traders exit too early, and how to stay consistent with risk reward. I'll see you in the next one. Until then, take care. Bye bye.